Hello and welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of Taiwan Semiconductor Manufacturing Company Limited, ticker symbol TSM. TSM has been a very highly requested business from subscribers. We previously looked at the business last year, but it's appropriate to make an updated analysis of the business, as in the third quarter, Berkshire Hathaway disclosed a $4 billion position in the company, with the sizing of the position making it somewhat likely that either Warren Buffett made it himself, or at the very least, if it's a large position from either Ted Weschler or Todd Combs, that Warren Buffett gave his approval. Even though the company has seen quite a dramatic rebound in their stock price since November of 2022, over the last year, their stock price is still down 24%, and currently the business is trading for $94.66 per share. Over the last 5 years, it's a totally different story. Taiwan Semiconductor is compounding at a rate of 16% annually. Over 10 years, they're compounding at a rate of 18% annually. And going back prior to the global financial crisis, over the last nearly 18 years, Taiwan Semiconductor Manufacturing is compounding at a rate of 15% annually. Keep in mind that the company also pays out dividends. Currently, the business has a 1.5% dividend yield, and their average dividend yield throughout this time frame would be in addition to this compounded annual return. TSM is trading more than $30 below their 52-week high, and they're trading more than $30 above their 52-week low. Taiwan Semiconductor is a very large business with a market cap of more than 14 trillion Taiwanese dollars, which when converted to USD comes out to about 490 billion US dollars. For more background about the business, Taiwan Semiconductor Manufacturing Company is the world's largest dedicated chip foundry with over 57% market share in 2021 per Gartner. TSMC was founded in 1987 as a joint venture of Philips, the government of Taiwan, and private investors. It went public as an ADR in the United States in 1997, and TSMC's scale and high-quality technology allow the firm to generate solid operating margins even in the highly competitive foundry business. Furthermore, the shift to the fabless business model has created tailwinds for TSMC. The foundry leader has an illustrious customer base, including Apple, AMD, and NVIDIA, that looks to apply cutting-edge process technologies to its semiconductor designs. The company was incorporated in 1987 and is headquartered in Hsinchu City, Taiwan. If you're interested in learning more about the business and the founding of Taiwan Semiconductor, the Acquired podcast has an outstanding episode on the business and does a great job highlighting how Taiwan Semiconductor CEO and founder Morris Chang really overcame the odds to start this business and make it a thriving company. So for our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of TSMC based off of their business fundamentals. So this analysis is still a work in progress, and it's an opportunity to learn in public, so it will continue to improve and get better over time. With that said, let's get right into today's analysis. Starting things off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. And there are 2 key reasons for this. The first is that over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns, and these business returns are going to be captured here by return on capital. The second is that the average publicly listed business earns about a 7% return on capital. So by asking for a benchmark of 14% or higher here, we can potentially build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average. Taiwan Semiconductor has earned fabulous returns on capital over the previous 5 fiscal years. They've never dipped below 20%, and additionally, they've been pretty steady. Over the last year, the company has earned 29.5% returns on capital, and average out over this time frame, they're earning about 24% returns on capital, which is well above that 14% benchmark we're looking for, and more than 3 times better than that of a typical business. So this is a strong check to start things off on metric number 1 for TSMC. Next up for metric number 2, here we're taking a high-level overview of the growth of their business, so we're looking for revenue, net income, and free cash flow growth over the last 5 years. This metric is going to be all or nothing in nature. Either all 3 of these are going to be up for this to be a check, or if even one of these is down, this entire metric will be an X. So over this time, Taiwan Semiconductor has more than doubled their revenues. Over their last year, they brought in more than $73 billion in revenue. Their earnings have almost tripled, and their free cash flows have more than doubled over this period as well. So this is strong growth across the board here. It's especially great to see such strong free cash flow growth, and the fact that the company was so strongly cash flow generative in all 5 of these years, because free cash flow is really the lifeblood of any business, and a business can use its free cash flows to buy back shares, pay down debt, pay dividends, make acquisitions, or reinvest back into the business. And ultimately, a business's abilities to produce free cash flows now and until Judgment Day discounted back by some reasonable interest rate, is what that business is going to be worth. Again, great to see such strong growth across the board here for TSMC. This is our second check of the day here on metric number 2. Next up for metric number 3, here we're taking the perspective of an individual shareholder in the business by looking at TSMC on a per share basis. So we're looking for earnings per share growth over the last 5 years. In our previous metric, we learned that their earnings have nearly tripled over this time frame, but we still want to look at what they've done in terms of their shares outstanding, which is pretty easy to do as they've kept their shares outstanding almost exactly flat, neither significantly increasing or decreasing their shares outstanding. Their earnings per share growth is almost exactly in line with their earnings, and this is a solid check here on metric number 3 as well. Next up, metric number 4 is going to be very similar. Here we're looking for free cash flow per share growth over the last 5 years. Again, because their shares outstanding are almost exactly flat, their free cash flow per share growth is going to depend almost entirely on their free cash flows, which have more than doubled over this period, meaning that their free cash flows per share are up as well over this time frame. This is another check here on metric number 4, and through our first 4 metrics, we are a perfect 4 for 4 on our analysis. Next up for metric number 5, here we're evaluating how the business is utilizing leverage. So we don't want to be investing in overly levered businesses, because during economic downturns, it's overly levered businesses that are going to be at the greatest risk of poor outcomes. So we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow that the company has produced over the last 5 years. So TSMC has had negative net debt in all 5 of these years, meaning that they had a cash position after paying off all of their debt. Right now, the business has about $23 billion left over in cash, and they brought in more than $17 billion in their most recent fiscal year. Over the last 5 fiscal years, the company has produced about $52 billion worth of free cash flow. And so with a huge cash cushion that in absolute terms is one of the largest of any business, this is a massive check here on metric number 5, as the business is strongly cash flow generative and they've got a seemingly very healthy balance sheet position. Then last but not least, our 6th and final metric, the big metric of them all, we want to see if Taiwan Semiconductor has what it takes to go a perfect 6 for 6 on our Select 6 analysis by seeing if their average free cash flow to their total enterprise value gives us a yield of 5% or better. If this is the case, this will potentially offer us a reasonable starting point for the intrinsic value of the company, and it'll give us a slight risk premium to the yield of the 10-year treasury. So right now, TSMC has a $445 billion total enterprise value, and we're utilizing their enterprise value because it takes into account both their market cap and their net debt position, which in this case is about $23 billion worth of cash, to give us a perspective of Taiwan Semiconductor that's going to be more similar to if the business were a private company. We learned in the previous metric that the company has produced about $52 billion worth of free cash flow over their last 5 fiscal years. So in an average year, the business is producing $10.3 billion worth of free cash flow over this time. So when we divide their $10.3 billion of their average free cash flow by their $445 billion total enterprise value, that unfortunately only gives us a 2.3% average free cash flow to enterprise value yield for the business. So this means that our first and only X of the day is going to come here all the way at the end for TSMC, as that's less than half of that 5% risk premium we're ideally looking for, and that's below the yield of the 10-year treasury. It's worth noting here by looking at their enterprise value that pretty much since it was reported that the company was being invested in by Berkshire Hathaway, that they've gained almost $160 billion in their market cap, which is a huge swing in absolute terms and has been a very sharp run-up for the business in terms of their stock price. Also worth being aware of is that over their last fiscal year, the company has produced $17.2 billion worth of free cash flow. So to get a current free cash flow to enterprise value yield for the business, when we divide their $17.2 billion of their last 12 months of free cash flow by their $445 billion total enterprise value, that gives us just about a 3.9% current free cash flow to enterprise value yield for the company. So while that is slightly better than that of the yield of the 10-year treasury, that's below that 5% benchmark we're ideally looking for as well. So just because this is an X here on both a current and an average basis of their free cash flows for metric number 6 doesn't mean that you're going to toss this business out in its entirety. This is just one of our 6 metrics, and while these metrics are simple, they're meant to be holistic in nature, and when they're combined together, they can be very powerful. Additionally, we've got some interesting aspects of the business left to cover. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze TSMC, which takes us on to using a discounted cash flow model to come to a potential fair intrinsic value for Taiwan Semiconductor. A discounted cash flow model is just like any other model in any other discipline. Its outputs are going to be sensitive to its inputs. Here we're starting with their current free cash flows and using historical growth assumptions based off how the company has grown their free cash flows since becoming a publicly listed business from their New York Stock Exchange listing via their ADR. So it's up to you to do your own homework here to determine whether or not these historical growth assumptions are going to be accurate and applicable going forward for the business to give us a baseline projected estimate for TSMC. If we assume that they grow their free cash flows at a rate of 14% annually for the next 10 years, and then assume that this growth is cut in half for the 10 years out after that, so projecting 20 years out into the future in total, and then we add in their tangible book value, which gives us an approximation of their tangible net worth. If we were ideally seeking a 15% rate of return from the business, which again is what Warren Buffett is ideally seeking from his investments, then it looks like a potential fair value for the company based off today's valuations is about $73 per share. That looks like there would not be a margin of safety in the business relative to today's current stock price, and that the company would be slanted toward being potentially more overvalued than undervalued or fairly valued. It also roughly lines up where Berkshire Hathaway was likely making its purchases into the business. Keep in mind that the company has seen a recent run-up in its stock price, and at the time of this recording, it's still to be seen whether or not Berkshire Hathaway has continued adding into the business in Q4 of 2022. There are a couple of caveats to keep in mind with this analysis. So one is that this 15% rate of return would be including their dividends. So 1.5% of this rate of return would be coming from their current dividend yield. And then two, a discounted cash flow model is based off the business's abilities to produce future free cash flows and how predictable those future free cash flows are likely to be. Taiwan Semiconductor has had very stable margins over the last decade and more, so this business, especially relative to some other types of businesses, seems like it does have that level of business predictability and stability that Warren Buffett would ideally be seeking from his investments as well. Their margin profile and the high capital intensity of their business has some similarities to Berkshire Hathaway's BNSF Railroad and even some of the energy assets owned under Berkshire Hathaway Energy. So as you consider those factors, please keep in mind that this type of analysis is not financial advice. It's not a buy or sell recommendation of any security. And before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. So in just a minute, we'll talk about our summary for Taiwan Semiconductor manufacturing, but we have to address something first. What are some of the qualitative aspects of this business, especially those that support the key points for either a potential long or a potential short thesis of TSMC? So starting with some of the key points around a potential long thesis for the company. Number one, TSMC will benefit from more semiconductor firms embracing the fabless business model and internet giants designing their own data center chips. Number two, TSMC wins when customers compete to offer the most advanced processing systems using the latest process technology. And number three, TSMC should consistently earn higher gross margins than competitors thanks to its economies of scale and premium pricing justified by cutting-edge process technologies. Then for some of the key points around a potential short thesis of the company. Number one, Samsung and Intel are committed to heavy capital spending under the support of the United States government. SMIC and other state-supported Chinese foundries also lurk as potential threats. Number two, TSMC's new approach to diversify production geographically may add cost pressures with little added resilience to stability. And number three, although TSMC is the foundry leader, each generation of process technology matures and commoditizes quickly, potentially forcing the company to deal with pricing pressure. So hopefully that offers a potentially balanced perspective around some of the key qualitative aspects of the business. Now it's time for a recap. So in summary, Taiwan Semiconductor Manufacturing checks the box on 5 out of our 6 metrics. The company earns average returns on capital of about 24% over their previous 5 fiscal years. They've also seen tremendous growth in their business over the same time frame, with their revenues and their free cash flows more than doubling and their earnings more than tripling. They've also kept their shares outstanding pretty much flat. Their business growth has really driven their per share growth as well. The company currently has a big cash cushion of $23 billion, and they're massively cash flow generative, generating $52 billion of free cash flow over their last 5 fiscal years, and generating over $17 billion over their last 12 months. Our only X of the day came when we looked at their average and their current free cash flows to their enterprise value and compared that yield to the yield of the 10-year treasury, as it does look like both of those would not be giving us that ideal risk premium we'd be seeking in comparison to the 10-year treasury, although on a current basis of their free cash flows, it does look like that's offering just a slightly better yield than the 10-year treasury. Finally, when we performed a discounted cash flow analysis of TSMC, if you have done the work and you believe that those historical growth assumptions are going to be accurate and applicable going forward for the company, and you're ideally seeking a 15% rate of return, then from these valuation multiples, it looks like a fair value for the company is right around $73 per share, which would likely be in line with some of the prices that the company was trading at when Berkshire Hathaway was likely buying into the business, although the company has seen quite the run-up in their stock price since that was publicly announced. So again, just because Berkshire was buying into the company doesn't necessarily mean that it was Warren Buffett himself making that purchase, although given the size of the purchase coming in at more than $4 billion, it is almost overwhelmingly likely that no matter who was purchasing it, Warren Buffett did have to give his approval for the purchase, so that's something to note there as well. And again, as mentioned, the margin profile of this company shares a lot of similarities to Berkshire Hathaway's BNSF railroad investment back more than a decade ago, just after the global financial crisis. Again, it's worth reiterating that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with your financial advisor. This analysis instead serves as a beginning and holistic understanding to help you determine whether it's worth your time and energy to dig in and learn more about TSMC. One resource that will definitely help you stay up to speed with what's going on in the market and help you learn more about the business is Seeking Alpha. Checking out Seeking Alpha directly supports the channel as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community-written articles on different stocks. But over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's algorithm. You can see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can add your own margin of safety targets and get alerts for when your favorite stocks hit that level. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years of financial data on any stock to help you with your analysis. You can also import your portfolio into your Seeking Alpha dashboard to make researching easier. And if that didn't convince you, the best thing is that an annual plan is only $119. That's just 33 cents per day through my referral link down in the description below. Normally premium is $239, but if you use my link, it's 50% off. So check it out if you're interested. As a value investor, you're ultimately trying to conduct this research as if you're going to own 100% of a business and you can truly understand its underlying essence, learning about the company accurately, completely, and then going back and asking yourself, what did you miss to get that full picture of the business, to be able to understand what's important and what's not important for the company going forward into the future. You'll learn more about the qualitative and the quantitative aspects of Taiwan semiconductor manufacturing, and you'll likely be able to determine for yourself what a reasonably appropriate intrinsic value for the company will be. So with that said, that's it for today's fundamental stock analysis of Taiwan Semiconductor Manufacturing Company Limited, ticker symbol TSM. Again, doing a revised analysis of TSMC was hugely requested from subscribers, especially after it came to light that Berkshire Hathaway owns a position in the business. So I'm happy to make an analysis of the company, and I'm looking forward to see whether Berkshire has continued adding to their position in the business, as that has not yet been disclosed at the time of recording this. So if you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about TSMC with me, and have a great day.